I have stopped some SIPs, you would have stopped some SIPs. If you were to put a gun on my head, I would say 50-50.
Biggest mistake which you have seen most investors make?
You like a fund, you invest in a fund, the results don't come, you still want to believe that, okay, my choice is great.
The more they see their portfolio, especially in times like these, the more anxious they become. I'm just curious, how often do you check your portfolio?
I check, actually I don't know my IRR.
One biggest misconception people have about sales side.
Huge. People think sales is some kind of a sabun selling exercise. You will go to building and the people will close the door on your face and all. Any choice that you make should either increase your returns or reduce your risk. You won't believe it. Of my total capital market portfolio, now 21%. The thing that is being spoken too much about is global investing. Are you talking about Korean economy growing at 8-9% for the next 10 years? Think not. Similarly, Taiwan, Brazil, 30% is 2-3 companies.
One habit that separates the investors who actually build wealth from everyone else.
Indian markets are not giving great returns, and global markets, all of a sudden you become asset allocator.
But would you suggest someone who has just started investing to start with global investing only?
See, we all are global investors. I'll tell you how.
Every fund house knows a number they rarely say out loud. Fund ka return versus आपके portfolio का return. Joining us today is Deepak Jain, President and Head of Sales at Edelweiss Asset Management. So this isn't a which fund to buy conversation. This is a conversation about investor behavior, which will change the way you think about investing. Welcome to Investing with FYERS, Deepak.
Thank you so much for having me here.
You have met thousands of investors across cycles. What is that one thing जो investors बोलते तो हैं but they do almost opposite of it?
That I am investing for long term.
Okay.
So you start with that assumption that you're investing for long term, and then the moment things go a little awry, people start getting nervous, change their plan. So if the plan was to invest via SIP for 10 years and then see things that gets changed, SIPs get stopped sometimes the fund gets changed. Even if you do lump sum and you say, okay, I have a long term horizon, my goals are 15 years, 20 years, a 20% drawdown really makes them change their perspective. But I don't really blame them. Many of the investors go through their journey and by making these mistakes they also learn. And I'm seeing that behavior change, and we'll talk more about it.
So I know there's also this interesting data that majority of investors stop their SIP within the first 3 years.
The journey of, let's say, saving, investing, especially in Indian context, mutual funds have been, private sector mutual funds have been in existence for almost 30 plus years. And in the initial first 15, 20 years, we saw that phenomenon even with greater intensity. Where any fall would result into SIPs getting closed, the SIP book getting collapsed. But post demon specifically, we have seen investors actually, there's a real change in behavior in terms of maturity. I call it aging of investor understanding of the entire investing scheme of things. And this has happened because people have seen wealth getting created via SIPs. Somebody investing 10,000, 20,000, 50,000, topping it up, markets being continuously positive from 2015 to almost 2024, 9 straight years, no negative years, actually made people realize some of their goals. The belief started actually seeing the light of the day. So I believe that that has changed a lot. But there are still investors who are new to the journey. People who might have joined in last 2 years, 3 years, and every bull run gets you new set of investors.
Yes.
They also get you new set of disappointments.
Yep.
So people who are disappointed, people who have not had that aging in terms of their experience, their journey, they might be doing it. And I call it a very, very par for the course. This is a behavior which we have gone through. I'm sure I have stopped some SIPs, you would have stopped some SIPs.
So if you have to put a number, okay, what percentage of investing success should be attributed to the product and to investing behavior or investors' behavior?
I think it's a good question, but a very difficult answer. Both are intertwined. If you get a great product and you don't really exhibit the behavior that is required for you to achieve those results, the great product would not result into great outcome for you. and vice versa is also true. So I think I would, if you were to put a gun on my head, I would say 50-50.
Okay.
But they are joint at the hip.
Okay. Now I have a follow-up question. Most of the time, the top selling product and the top performing product, they are same, right? So what is the cost which an investor pays for the gap?
So the cost could be very, very high. So one of the data that we saw,
Hmm.
that if a fund
Hmm.
is number one ranked in 1 year performance, it gets disproportionate share to the tune of 40% of that year's flow.
Okay.
So, but the performance is in the past.
Hmm.
The year that it is getting flow, it may not be necessarily be the top performer.
Hmm.
While the flows are actually chasing a return rather than leading. So that actually results into misallocation of capital, over allocation of capital, overconfidence, and then there is a cycle. So you like a fund, you invest in a fund, the results don't come, you still want to believe that okay, my choice is great,
Yes.
and you would not change that, and that actually creates a lot of gap in investor portfolio versus the fund returns. The ideal way is to pick a fund and stay the course. Each fund would see its cycle of great performance, average performance, and underperformance. And most of the active managers, most, do a reasonable job of giving you a benchmark plus. So this particular attribute where you choose funds only on the basis of last 1 year returns doesn't help anyone.
Okay. We have access to so much of information. Still, investors make mistakes. So, what is that one biggest mistake which you have seen most investors make, especially in recent times?
So this has always been the case that you look at a particular asset class or particular security, and let me give you a live example of last 12 months. Gold, for instance.
Yes.
When in June last year, just 12 months ago, silver was below $36. It just went up, shot up like anything. And the amount of flows that we got, the industry got in December, January, February was unimaginable. As if there is no tomorrow. The returns that you have got in last 1 year will also get replicated. So this, extrapolating short-term asset class behavior to long-term aspiration is something we have seen time and time again. Whether it's equities, gold, silver, property, anything, the recency bias. So this is something which is very, very prevalent, and we need to be able to avoid it. The only way you can avoid it by following some path of asset allocation, discipline. But it's easier said than done.
Yeah. Speaking of gold, silver, ever since like last year, we have seen so much of content on investing in gold and silver. Do you think these are actually influencing investors' behavior more than it should have?
No, I'm saying multi-asset allocation has been spoken about in India for last 6-7 years very, very aggressively. But asset allocation as a principle have been spoken about by many people. Let me throw some statistics at you. If you look at India's total household wealth, it's close to 22 trillion. Guess how much is gold, silver? It's close to 20% and more.
Wow.
So you already own close to 4 to 5 trillion dollar worth of gold. I mean, owning, let's say, 10 lakh more or 20 lakh more at each investor level, it's just about FOMO.
Yeah.
You don't mark to market your jewelry, your physical gold, etc. And that's why there's a feeling that okay, my friend made so much of money by investing in that ETF and this ETF, so why should I miss out?
Yes.
And that trading mindset is always there in investing. I mean, you are a blend of investor and trader. So it's about how far you would go in trading versus investing, and again vice versa.
But there must be some shift in trend, no? Like physical gold holders we have been for decades now. Now digitally we are getting more inclined towards it.
So if you talk about ETFs, for instance, the ETF in India gold ETFs have been there for almost 20 odd years. But the amount of flows and the growth in AUM that we have seen in last 12 months has never been seen.
Yeah.
Because if you look at history of gold, let me just give you some 40-year history.
Okay.
In 1984, gold was $800. And from there till about 2003, it came down to $300. But in India, we never actually witnessed the collapse. because of rupee depreciation. So every year 6, 7, 8%. So it became some kind of a debt allocation or gold to lena hi chahiye. So people kept on buying gold. But then there was a period when for almost after 2008 for almost 7, 8 years gold didn't do anything, and equities were the flavor of the day.
Yes.
So people forgot about gold buying. Even at a personal level, if you see the new generation doesn't buy that amount of gold that earlier generation used to buy. But again, because of this recent phenomenon of price moving up, and when equities didn't do well, particularly in last 24 months, gold, silver, or any other asset class which moved, international equities, for instance, all of a sudden people want to buy an emerging market fund, a US fund, a China fund. These funds were there, but people get the trigger is always short-term returns.
Yeah. But what do you think would have been the major influence for them?
The short-term returns. I'm telling you, there is no rocket science. People pick up things when things start looking hot. So greed and fear. I mean, this is the classical theme which is playing out. Just assume markets were to fall 20% more. People will flock to FDs. So it will be fear, playing out. So it's very, very, repeated thing that is getting played out over and over again. We have to overcome the cycle. And that's our job. People like you, me, we have to tell people to not look at everything from the prism of short-term risk returns. There has to be a more long-term thinking in everything that you do.
One positive change which has come to Indian investors over the years.
If you look at SIP, again, 3 years ago, the book was 14,000 crores, just 3 years ago. And today it is 31,000 crore. And it has just fallen from 32,000 in March. So 3% fall. There are people who would do a lot of analysis on how SIPs have come down and blah, blah. But I look at the fact that in the last 3 years where people have not made too much of money, this 14,000 crore book have almost gone up by more than 100%. And many of the investors would be continuously investing, topping it up. So this amount of maturity that we have seen is really remarkable. Where people are allocating money for long term, people are thinking about their goals beyond a 5-year and 10-year. People are planning retirement. People are planning for a big spend like house, education, etc. So this is a huge change. People's consciousness about money and managing money has become much, much aware and better.
A lot of people say that the more they see their portfolio, especially in times like these, the more anxious they become. I'm just curious, how often do you check your portfolio?
I check once in 6 months.
Okay.
Actually, I don't know my IRR.
Okay.
I only check how much I have put in. Because I believe that I'm in a building up phase. I should not be worried about what the outcome is as long as my process is right. So I follow a certain asset allocation and I stick to that. If the prices move up or down, it doesn't really bother me, honestly. I have not redeemed a single rupee because of fear or put more money because of greed.
Wow.
So because I only look at contribution. So I am treating this as a build-up phase. It's like, bringing up a child.
Yes.
If you start after 4 years of, your kid being born and all, you start, tu kya de raha mere ko? That will be a problem, right? 4 साल के बच्चे से मैं कुछ मांगने लग जाऊं. In fact, you should not. You should just give, especially in this phase. So I'm looking at it from that perspective.
While I'm sure my audience, not all of them would know this thing about you. You are a CA. So recently, Radhika has also wrote about, 85% of finance CVs chase one job, which is research. You are a CA. You could have been one of them, yet you went the other way. So I have a couple of questions for it.
Okay.
Why did you do that? And do you think research crowd is chasing prestige and missing where the real understanding of investors really is?
Let me answer the second question first. On the research side, it just sounds very fancy that I'll be doing research and especially equity research and all.
Yeah.
But it's quite, I would say, it's coming from a place where people don't understand that how much supply and demand is there in this particular space. I would have been happy if people were lining up to research more medicine, more tech innovation, etc. That is not happening in India. But everyone wants to be an equity analyst and There are only 700,000 worth, stocks worth investing, really from a size perspective. So how many analysts would you need? So I think this is a misplaced priority, misplaced aspiration. Perhaps they are not aware that personal finance could also be as interesting as corporate finance or the investing world. So I think we also have failed or not really lived up to their expectation in terms of showcasing opportunities in this personal finance space. And I think it's high time that we do it. On the other side, why did I join? There was a chapter in my during my days called MAFA, Management and Financial Accounting, which was all about market, stock, valuations, etc. And I was just intrigued to the idea of creating money, talking about money. Got an opportunity at the right point in time. Mindset, I was always a businessman. I was an entrepreneur. I just did CA for the sake of doing it. Being in Kolkata, Marwadi, this was something that you have to do. Us samay, at those, right? And this education was cheap. The fees were 3,000 to get in, and if you worked hard, you would make a career out of yourself, out of this degree. So I chose it because I had a good background in terms of understanding of markets, personal finance, and that inclination towards it.
Another question is that now, since you have been in this for so many years now, what is that one biggest misconception people have about sales side of investing?
Huge. People think sales is some kind of a sabun selling exercise. You will go to a building and the people will close the door on your face and all.
Yeah.
Sales has, and I don't actually see myself as a salesperson. As I said, I see myself as an entrepreneur, as a business builder. And once you see yourself as business builder,
Yes.
sales is just an outcome. I mean,
Yes.
you need to build business. Every business needs to be able to take the product and services to the clients. That's my job, but in the right way. And in our industry, it's about right selling, educating, making people aware about pros and cons. And it's more B2B selling, like wholesaling. We talk more to advisors and distributors than direct clients because we believe that since we don't necessarily have the wherewithal to understand the client's journey, the risk return matrix, we are not in the best position to advise. We're in the best position to talk about the product and how it could suit a certain set of customers. Like a medical representative would do, meet a doctor and talk about a particular medicine, how it could be used in a certain treatment. So our job is more on those lines, not necessarily door to door B2C kind of a role. And it encompasses its entire gamut of product, process, long-term thinking, so on and so forth.
What is that one thing, or let's say, what is that thing which you feel AMCs, distributors, they know more about investors than investors themselves?
But this entire thing called risk tolerance and risk appetite. Now, I don't know what is the technical meaning of these two words, but I see them a little differently. For me, risk appetite is basically a financial measure. Your financial ability to take a risk. Let's say you have 20 crores of portfolio. If you lose a crore, will it make too much of a difference in your lifestyle? It will not. You will still be 19 crores. You will have 19 crores. If you lose 90% also, 2 crores will not make you come on the street. You will still survive. But how do you react to a certain event? So let's say it's the same example, 20 crore portfolio, 5% down and you start panicking.
Yeah.
Your appetite is great, but tolerance is very limited. So I think people overestimate or underestimate their appetite and tolerance. But by looking at the behaviors, I think people like us at some time, but more so people who are advisors, distributors, they've seen the cycle, they've seen the behavior. So they understand the risk appetite and tolerance much better than the client themselves.
Okay. Speaking of risk appetite, we have a new entrant in the market now, SIFs. How do you see that? And let's say someone who wants to invest, what is that one advice you would like to give them? How to see that product?
Before I talk about SIF, just look at the landscape of publicly available money management platforms. There are three. I mean, there's a mutual fund, there are PMSs, and there are AIFs.
AIFs.
The PMS regulations came in 1993. The mutual funds came in 96 and AIFs came in 2012. Pretty decent history, right? Almost decade and a half for AIFs and more than 30 years for PMS and mutual funds. Yet mutual funds that have 80 lakh crores of AUM and both others put together ex CPFO money is 20 lakh crores or less than that. Why is that? I think that MF as a platform is very efficient in terms of cost, tracking, accounting, taxation, which is a big thing. I mean, look at a PMS where if you trade any security, all such trades are subject to taxation for the year.
Yes.
Accounting is quite cumbersome. On the other hand, if you don't do any thing and you have just invested into a mutual fund, there is nothing that you need to do, no tax that needs to be paid, no fresh accounting that needs to be done. So the platform and this entire ecosystem is so superior. SIF is just a byproduct or a superset of mutual fund. It allows mutual fund to do 2-3 things which it was earlier not allowed. For example,
naked shorting.
25% naked short, a little bit more concentrated portfolio on the credit side, some bit of more options on the derivative, like just to give you an example, covered calls. A covered call is a call where you have a long position on the cash side and you sell options. Now, in the mutual fund, you can still do it, but only in Nifty 50 stocks and only up to 30% of the cash position that you hold. So, if you hold 100 shares of, let's say, XYZ company, you can only do 30% of covered call. On the other hand, in SIF, you can do non-Nifty 50 also. You can do up to 100%. And that becomes a very great product or great instrument to deliver superior risk-adjusted strategies or returns to customers. So SIF, in my opinion, any choice that you make should either increase your returns or reduce your risk, right? If an investment is neither reducing your risk or not increasing your returns, it's futile. So you should look at SIFs in that context. If a particular scheme or a strategy is giving you better risk-adjusted return, then it's worth looking at it.
Yeah.
So I would look at it from that perspective. You won't believe it. Of my total capital market portfolio, now 21% is SIF.
Wow. Another question I have about SIFs, since it's still a fairly new product in Indian markets, do you think we have our fund managers have just the right kind of knowledge which is required?
It's a very good question that you have asked. So now SIFs can also be used as an alternative to PMSs, which is long only.
Yes.
But in many cases, you will need to have the skill set to use derivatives well. And that skill set is limited. The talent on shorting, the talent on using derivatives more efficiently is limited. So yes, there is a dearth of talent. But if you never gave that platform, there would not necessarily be the urge to develop those skill sets. But those skill sets are there. People are using that in prop, in AIFs, etc. If you go back in time, did you have enough fund managers on the long only side? When I was growing up, we knew about 4, 5, 6 great managers and all. Today, there are hundreds of managers and they're doing very well. Many of us won't even know their names. So I think it'll be, demand will get the supply kind of a thing.
Another question is that what is that one risk which you feel no one is talking about right now? And also, what is that one risk you feel has been overemphasized on?
The one risk that I feel at this point in time, after 2 years of flat, is people getting a little, frustrated about Indian markets, and that is evident in May AMFI sales.
Yes.
It dropped by almost 50%. It's an indication of frustration, creeping in, and it's very natural. But I believe that the risk to Indian markets could be more on the upside than on the downside, because we have seen most of the risk that we spoke about, whether it's, let's say, geopolitical risk, lower earnings risk, tariff related issues, currency related issues, all have played out, and market is where it is. It's not really far off from its peak. It may not have given you too much of returns, but it is not really down 40%. So there must be some inherent strength in the market, which the market is, talking to you. So if market is talking to you, you must listen. So I would urge people to stick to their asset allocation and not give up. In terms of risk which is being spoken about, or I think a thing that is being spoken too much about,
Yes.
is global investing.
Okay.
A lot of geographies, a lot of strategies have delivered 100% and 50%.
Yes.
Where, let's look at Korea, for instance. Single company 35%. And are you talking about Korean economy growing at 8-9% for the next 10 years? I think not. Similarly, Taiwan. Similarly, you go to Brazil, 30 odd percent is two, three companies. Look at India. I mean, such a diversified range of businesses that you have. So MSCI has 21 subsectors. 19 of them are present in India. After US, India is the most diversified market. So you've got so many things going for you. Maybe last 24 months haven't been great, but I think the opportunity of global investing has been overemphasized. At the same time, I would like people to look at it in from an asset allocation perspective and not just a short-term return making point of view.
Because earlier, I know it was like, okay, 10-20% you diversify and put it into other markets. But right now, given the returns which Nifty and Indian markets are giving, investors are looking for more percentage of their portfolio getting diversified to other markets.
So what happens is that whenever Indian markets are not giving great returns and global markets, all of a sudden you become asset allocator.
Yeah.
And you find this great urge to investing in global market, but it has to be consistent. Like your Indian portfolio is core and consistent, and you don't necessarily make it 0 or 1. You should not do it with your global investing also. Don't get overexcited and over pessimist also. So for example, next year if you don't make any returns in global investing, it doesn't mean pack your bags and leave.
Yeah.
So you need to stay invested to the cycle for one to be able to make money.
But would you suggest someone who has just started investing to start with global investing only?
See, we all are global investors. I'll tell you how. So as I said, $22 trillion is our household saving. How much is gold? 5 trillion, 20 odd percent. What is gold? Is it domestic investing or global investing?
Global.
It is global investing. Gold is neither produced in India nor priced in India. Yeah. We think gold is domestic. 20% is anyway starting. You invest globally.
Yeah.
You add 5% more in equities. Okay. It won't change too much.
And what is an opinion you hold about mutual funds that most people in your own industry won't agree to?
So I think we don't speak enough about the efficiency of mutual fund, the beauty of funds. So today, if you want to redeem your money in 2 days, you get it. You want to invest, you can invest seamlessly. Once your KYC is done, it's just click of a button. The convenience aspect of mutual funds are not spoken enough. You take any other investment, property, alternate investment, some government small savings schemes, etc. To get your own money is a hell of a task, and mutual funds make it so easy. I think as an industry we don't speak enough about it. The worst of the funds comparatively would have done better than the other alternative that people would have invested in. So there's a lot of conversation around comparison, fund performance, which there should be, but not enough on convenience.
So time to switch gears, Deepak. Time for a rapid fire round. I will ask a couple of questions and you need to answer whatever comes to your mind first.
Sure.
So if you could ban one product or behavior from the industry tomorrow, what goes and why?
So one behavior or practice of looking at point-to-point returns, I would like to ban and focus more on rolling returns. That would give more better information to customers on consistency of a product rather than just point-to-point outcome.
Okay. One thing investors should start and stop doing immediately.
So I think people should start planning immediately and stop overthinking.
One habit that separates the investors who actually build wealth from everyone else.
Patience.
Okay. The single question every investor should ask before any investment decision, what is it?
What's in it for me? Is it really worth it?
Given everything you have just said about how investors actually behave, what is Edelweiss doing differently to design for that behavior rather than profit from it?
So we are building this entire suite of SIFs with a clear, solution orientation in mind. For example, hybrid long short that we launched. We've tried to, cater to a low risk fixed income kind of investor who doesn't necessarily want to participate in either equity market volatility or commodity market volatility, but still is happy with an 8%, 8.5% post-tax over a reasonable period of time with low volatility. Those kind of things we are doing. We will be doing much more in upcoming months and years in other products. But a solution oriented approach to building SIF is something that we are very excited about.
Okay, and my last question. You have got every investor in India for exactly 60 seconds and they're actually listening. What is that one message you want them to hear?
I think, when you manage your money, whether it's an investor or even an intermediary, there are dual roles that you need to play. One is the role of custodian, where you are very particular about how you manage money, careful, risk, returns, everything. The second one is beneficiary. You should also enjoy your money. Resources, whether it's money or anything else, if they are not really put to use, you don't necessarily feel whether you have made it or not. So it's important to have an expenditure plan also along with your savings and investment plan.
All right. Well, with that, we wrap up this episode of Investing with FYERS Conversations. Thank you so much, Deepak, for joining in and sharing insights
It
with
was
us.
such a pleasure being here. Really look forward to another session some other day.
Likewise.
Thank you.
Well, honestly, this has been one of the most open conversations about investing we have had on this show. So if you enjoyed today's episode, please like, share, and subscribe. It helps us bring more conversations like this one to you. Until next time, keep learning, keep questioning, and keep investing with FYERS. This is Investing with FYERS. Investment and securities markets are subject to market risks. Read all the related documents carefully before investing.